Okay, we shall begin. Good afternoon to our participants in Asia and good morning to our friends there in Europe. And welcome to our Scientific Beta webinar on the subject of defensive equity to improve the performance of multi-asset portfolios. My name is Simon Caraban, and I am the Senior Vice President of Index Services at SGX. Today's webinar is indeed a very timely one. Within the context of the current macro environment, there have been several question marks raised around the efficacy of the traditional multi-asset portfolio. Once the cornerstone of a multi-asset portfolio, the traditional 60-40 allocation is now being scorned by investors who fear that it can no longer work today as it had once done in the past. You are probably very familiar with some of the more recent news articles that are very critical of the traditional multi-asset portfolio. I'll actually now indulge you with some of the more recent headlines that I have actually come across. One headline is death of the 60-40 portfolio, which comes up quite frequently. Another one that we see is rethinking the 60-40 portfolio. Another one that has come up as well is investors wonder if the 60-40 portfolio has a future. And last but not least, one of the headlines I've come across is the 60-40 portfolio is in big trouble. So we have been peppered with such headlines in recent months. So you have to ask the question, why now? And we really feel that the reason is threefold. One, the defensive fixed income seeking component of the portfolio is offering very low returns in an low rate environment, especially as it relates to lower risk investment grade bonds. Second, the fixed income component is no longer considered to be very defensive at all, as we are confronted with the very real threat of inflation and a rising rate environment. And three, there are growing fears surrounding equity valuations that are being tested on an almost daily basis, with evidence emerging of a rotation out of technology stocks, which is driving up equity market volatility and triggering some recent drawdown events. Some would suggest it's time to look at the relatively illiquid alternatives, such as real assets, to improve the risk-return profile of multi-asset portfolios. If you do allocate to such assets, however, one must also consider the effectiveness of managing real illiquid assets, as well as the opportunity cost of giving up equity risk premium. Naturally, we disagree with this approach. In today's webinar, we will demonstrate how you can increase your exposure to equity, collect the equity and factor premium for a given level of risk, and significantly mitigate drawdown events. We will show that the risk-return profile of multi-asset portfolios improves significantly as you substitute a portion of the fixed income allocation to our dynamic defensive equity solution. Certainly, not all defensive equity solutions are created equally. Therefore, we will also touch on the advantages of our dynamic defensive equity index, which offers an elegant and efficient solution relative to traditional defensive solutions in the market today. As we walk through our presentation, you will have the opportunity to submit your questions in the Q&A section of this webpage. We will do our best to address every question possible at the end of Eric's presentation. I now have the pleasure of welcoming our Global Research and Investment Solutions Director, Eric Sherbini, who will walk you through our presentation now. Thank you, Eric.
Thank you very much, Simon, and thank you very much for that introduction. When you were reading out those headlines, I was trying to think which one rhymes the most. And I think the one about rethinking the traditional 60-40 equity portfolio is probably the one that's most relevant. So thank you very much for the introduction, and welcome to all our viewers in both Europe and in Asia. As you can see, that the title of our presentation today is making a case for making an allocation to defensive equity to improve the performance of multi-asset portfolios. And as Simon said, we are going to focus very much on a certain kind of defensive equity strategy, our dynamic defensive strategy, which helps us to greatly mitigate some of the risks. So in terms of an outline to the presentation, I will, first of all, in the introduction, make a case for an allocation to defensive equities, looking at some of the more traditional approaches to defensive equity. And then I'll also make a case for an allocation to our dynamic defensive strategy as well. And then in the second part, we will move on to looking at some case studies in terms of how much allocation you can actually make to the equity sleeve using our dynamic defensive strategy. Now, our dynamic defensive strategy actually uses a risk control applied to a low volatility, to a more traditional defensive strategy. So we will look at some of the traditional defensive strategies out in the market today and look at ways we can improve on traditional defensive equity strategies, and also then explain a little bit about how we introduce the dynamic element to a defensive strategy. We'll present some results in terms of performances of our dynamic defensive solution, and then have a very simple conclusion. So let's start off. In a multi-asset portfolio, an allocation to equities is often made in order to provide access to good long-term risk-adjusted return. So if you like, this is in order to try to achieve some kind of long-term growth for a multi-asset portfolio, an allocation to a risky asset class like equities is often made, and very often multi-asset portfolios use a cap-weighted index. Now, a cap-weighted index also exposes the investor to the drawbacks in terms of market volatility, extreme events, and tail risks. And what this means in practice is that it limits the amount that is actually allocated to the equity component of a multi-asset portfolio, because the idea of a multi-asset portfolio is to try to achieve growth, but also to have low risk. Now, one way of mitigating these extreme risks and the high market volatility could be to invest in a defensive equity strategy, such as a minimum volatility strategy. Now, minimum volatility strategies provide better protection in down markets, so therefore allowing you to make a greater allocation to the equity sleeve. And also the interesting aspect of a minimum volatility strategy is it provides very good risk-adjusted return, because in addition to providing exposure to the equity market risk premium, it provides exposure to the low volatility premium, resulting in better risk-adjusted return. So there is a good case for making an allocation to a defensive equity strategy instead of a cap-weighted index in a multi-asset portfolio. However, traditional defensive equity strategies, like the minimum volatility strategies, are not always low volatility. So in this slide here, what we show is the one-year rolling volatility of a cap-weighted portfolio, cap-weighted index. That's the blue line you see running along the top. And we also show the volatility of a rolling volatility of a minimum volatility strategy. Now, what we can see here is we can see that the minimum volatility strategy does indeed have a lower volatility compared to the cap-weighted index. But what is important and interesting is that even the minimum volatility strategy suffers in terms of an increase in risk, an increase in volatility during times of market stress. So yes, it does have lower volatility than the cap-weighted index, but it also has an undesirable property in the sense that volatility still increases during times of market stress, which is exactly when you want to have some kind of protection from the defensive equity strategy. So what we are proposing is a dynamic defensive strategy. So in this slide here, we also show the rolling one-year volatility of our dynamic defensive strategy. And the idea of this defensive strategy is to introduce what we call a maximum volatility protection. It's a risk control that aims to reduce exposure to the equity market in terms of high volatility. So the underlying strategy is still a defensive equity strategy, a well-designed defensive equity strategy, but we have an additional volatility protection, which we will discuss and explain exactly how we do that. But what we see here clearly is that during times of market stress, you tend to have much significantly lower volatility, and that has an important impact in terms of how much you can then allocate to the equity portion of your multi-asset portfolio. In fact, in this table here, we compare the different levels of risk you have using a cap-weighted equity portfolio. That's in the first column, and in the last column, a more traditional defensive portfolio like the minimum volatility portfolio. Now, we can see here, in terms of maximum drawdown, we can indeed see that something like a minimum volatility portfolio does reduce the level of the maximum drawdown from around about 55% to 46%. So indeed, it does offer some kind of protection. But by controlling the volatility during extreme market stress, you can see that our dynamic defensive solution has significantly less drawdown. In fact, about half the level of drawdown of a traditional traditional minimum volatility defensive strategy. I mean, maximum drawdown is only looking at one point in time, but even if we look at averages in terms of the worst rolling returns, the 5% of worst rolling returns, again, we can see that our dynamic defensive strategy has significantly lower worst 5% returns than both the cap weight, and in fact, again, about half the level of the worst returns compared to a traditional minimum volatility strategy. Now, this improvement in terms of risk, having lower risk at times of crisis, of course, means that it gives us confidence to allow us to make a greater allocation to the equity sleeve and therefore improve the long-term risk-adjusted return for our multi-asset portfolio. So that's the main case we will be making in the presentation today. So in the first part of the presentation, what I'd like to do is to show two very simple case studies that demonstrate the benefits of using this dynamic defensive equity solution compared to the cap-weighted solution and also compared to the more traditional minimum volatility type solution. So for each of these two case studies, we will show how much you can actually allocate to equities and bonds, assuming that you are targeting the same level of risk for the multi-asset portfolio. Once we target the same level of risk, we can then see the benefit in terms of the improvement of performance of returns, not just on average, but also looking at some extreme returns, so looking at the distribution of returns as well. So that would be the first part of our presentation here today. And then in the second part of the presentation, we'll dive into a little bit more detail about how we construct our dynamic defensive strategy. And in particular, we will explain a little bit about how we reduce volatility in times of market stress. But this risk control, this volatility control that we apply is actually applied to Scientific Beta's low volatility strategy, which also has some additional benefits compared to more traditional defensive strategies like the MSCI minimum volatility strategy. The volatility control, the dynamic element of our strategy, can be implemented in a very, very cost-effective manner as well, which makes this solution an ideal candidate for a multi-asset portfolio. Okay, so let's begin with a couple of case studies to demonstrate the benefits of using our dynamic defensive solution instead of using a cap weight or comparing it with a cap weighted allocation to equity, and also an allocation to a more traditional defensive strategy such as minimum volatility. So the two case studies that we're going to look at is, first of all, let's try to target the same level of risk. In other words, let's try to target, in case one, the same level of volatility as a traditional 60-40 equity bond allocation using a cap-weighted, based on a cap-weighted equity allocation. And in the second case study, let's try to target or try to see how much you can allocate to the equity sleeve with the same level of the worst one-year rolling return, of minus 5%. So for each one of these case studies, we will show the allocation needed between the equity sleeve and the fixed income sleeve to achieve the same level of either volatility or worst one-year rolling return, not breaching 5%. So turning to the first case study. So as we see here in the table, in the first column, we show that for a 60-40 equity allocation, so 60% allocated to equities, 40% to fixed income, over the long term, that gives us an annual volatility of about 11.5%. Now let's try and target that same level of volatility using a traditional defensive strategy, such as the minimum volatility strategy that we see on the far right-hand column of this table. So to achieve the same level of volatility using the MSCI min vol strategy, you can see you can actually allocate a little bit more to equities, 70% instead of 60%. But you can see that using our dynamic defensive strategy, in order to achieve the same level of annual volatility, you can allocate significantly more to the equity sleeve. In fact, you can allocate around about 93.5% to the equity sleeve. Clearly, this is very desirable property because allocating more to the equity sleeves means better risk-adjusted return, again, for the same level of average volatility, average risk. Now, because we can actually allocate more to the equity sleeve, you can see we have better returns. So if we look at the average one-year rolling return, we have considerably higher average returns. In terms of also looking at the distribution of returns, if we look at the 5% best cases and 5% worst cases, we have much better returns in the 5% best cases and also better returns in terms of the 5% lowest cases by making this 93% allocation to our dynamic defensive strategy. And you can see a similar picture if we look at 3-year rolling returns. Again, we end up with higher average returns and also a better distribution in terms of lower better worst returns compared to both the minimum volatility and the cap-weighted portfolio. So that's the first case study. Now, this case study has focused very much on trying to target the same level of average risk to the various equity strategies. But what investors are perhaps more concerned about in a multi-asset portfolio is trying to limit the level of the worst performance over a particular period of time. So here we're going to look at a 1-year rolling window. And what we're going to try to do is try to ensure that the worst returns over a one-year rolling window don't exceed 5%. Now, in order to achieve this objective, what it means is for the allocation to the cap-weighted portfolio, you would allocate 36% to the cap-weighted portfolio in order to ensure that you don't suffer more than a 5% drawdown or return over a one-year rolling window. Now, the MSCI min volatility strategy, you can allocate a bit more, in fact, 48.5% to the equity allocation in order to achieve that same objective of no more than a 5% negative return over a one-year rolling window. Now, for our dynamic defensive strategy, you can see because we're controlling the volatility, particularly during times of stress, you can allocate a much greater amount to the equity portfolio, to equity portion. Almost 70% can be allocated to the equity portion. And obviously what this means is you have better returns over the long run. And we show here the returns both over a one-year rolling window and over a three-year rolling window. So, to summarize, the dynamic defensive solution reduces both the average volatility and also the risks, particularly during times of market stress. This makes the dynamic defensive solution an ideal candidate in a multi-asset portfolio, particularly compared to both a cap-weighted or a defensive allocation. So we saw in our first case study for a 60-40 multi-asset portfolio, 60% in equities, 40% in fixed income, targeting the same level of volatility, average volatility, you can allocate 33% more to our dynamic defensive solution. And in fact, you can even allocate 23% more compared to a more traditional minimum volatility solution. And the impact of that in terms of return is it improves returns by an average of between 17 and 21% compared to the cap-weighted and a traditional cap-weighted equity portfolio. So the dynamic defensive strategy is a very interesting component in a multi-asset portfolio. So what we would like to do now is to dig a little bit deeper in terms of what this dynamic defensive strategy looks like and how it's differentiated compared to more traditional defensive strategies. So there are three main elements in terms of the design of our dynamic defensive strategy that are important and help us improve in terms of the level of risks, both extreme risk and average risk. So traditional defensive strategies are useful ingredients in multi-asset portfolios because, as we said, they aim to protect in down market conditions and also offer better risk-adjusted return compared to the cap-weighted index. Now, the reason they provide better risk-adjusted return is because they also provide exposure to the low volatility risk factor. So not only are you collecting the equity market risk premium, you're also collecting another risk premium, the low volatility risk premium, which provides us better risk-adjusted return over the long term. But being exposed to the low volatility risk premium also means we have better protection. Defensive equity strategies, basically there are two types. The type of strategy that we use at Scientific Beta essentially harvests the low volatility risk premium. So we'll show you a little bit more about how we design our low volatility strategy. And the alternative approach is to use a minimum volatility approach, an optimization approach that targets the lowest volatility on the efficient frontier. However, this minimum volatility approach also suffers from a number of drawbacks. So the first drawback is A traditional defensive strategy, like a minimum volatility strategy, also suffers from negative exposure to other well-rewarded factors. So in this table here, we look at the exposures, we look at the betas of the MSCI min volatility strategy to the various well-rewarded risk factors, the factors that are associated with a positive risk premium over the long term. So we can see that a minimum volatility strategy does indeed provide us with a very high exposure, a very high beta, 0.34, to the low volatility risk premium. But by focusing on this low volatility risk factor, or focusing on the minimum volatility portfolio, it also introduces a negative exposure to some other well-rewarded factors. Because the low volatility factor is actually decorrelated or uncorrelated to some of the other known well-rewarded factors, if you don't actually control for it, you actually naturally end up with a negative exposure to other well-rewarded factors. So here we show that the minimum volatility strategy ends up with a negative exposure to momentum and also to the quality factors as well. So the idea is that the minimum volatility strategy is an interesting strategy because in addition to the equity market risk premium, it provides us exposure to the low volatility risk premium. But unfortunately, we also lose some risk premium as well because we have negative exposure to other factors that are rewarded over the long term. So if you look at the factor intensity, which is simply the sum of the betas to all the different well-rewarded risk factors, you can see that even though we have a beta to the low volatility factor of 0.34, when you add up the betas to all the other factors, that's actually reduced to 0.22. So you're actually limiting the benefit that you're getting in terms of the low volatility risk premium by actually giving back some of the premium by having negative exposure to other rewarded factors. So what we do at Scientific Beta to create our defensive or our low volatility strategy, it's based very much on the factor harvesting approach. And what we do is we simply select, as the first stage of the process, we select the low volatility companies. Once we've selected low volatility companies, the idea being, of course, to try to capture the low volatility risk premium, what we do is we introduce a filter, we call it a high factor intensity filter, that removes the stocks that have a very strong negative exposure to the other well-rewarded factors. And you can see the benefit of this filter in the first column of this table. You can see that by explicitly selecting the low volatility companies, we have the same or similar exposure to the low volatility factor. But this time, we've actually reduced the negative exposure to the other well-rewarded factors. So when we look at the overall exposure to the well-rewarded factors, we actually have an improvement, a higher factor intensity to all the rewarded factors. And therefore, over the long term, we would expect better returns because we have a positive exposure or stronger positive exposure to well-rewarded factors. And in fact, that is indeed the case. So we can see here that the cumulative return of our low volatility strategy compared to the MSCI minimum volatility strategy, we have a 2% better return than the MSCI minimum volatility strategy. And what is interesting is that this better return comes both in times when the low volatility factor is doing well and when the low volatility factor is not doing well. So this is important, particularly during periods of time when the low volatility factor is not doing well. We then have we reduce our negative exposure to factors that are doing well at that point in time, so we collect better returns. But overall, in the long term, by ensuring that we eliminate negative exposure to well-rewarded factors, we end up with better long-term returns. So that's the first aspect of the design of our low volatility strategy. The second aspect relates to the fact that traditional defensive strategies also lack diversification. So in this slide here, we look at the effective number of stocks. So a minimum volatility strategy, the effective number of stocks, you can see is around about 81. Now, apologies, in fact, what I have just noticed is I have these columns the wrong way round. So the figures that you see for the MSCI US minimum volatility strategy are actually the scientific beta figures. So you can see that the second column has a higher effective number of stocks, and that leads to a higher Sharpe ratio over the long term. And the reason for that, of course, is that what we do at Scientific Beta is once we've selected the companies, we apply a very well diversified weighting scheme. This diversified weighting scheme reduces our exposure to stock-specific idiosyncratic risk, because ultimately, over the long term, idiosyncratic risk is not well rewarded. So by having a higher effective number of stocks, you can see the change in specific volatility. We have a reduction in terms of the exposure we have to specific risk. And over the long term, shown in the second column here, you end up with a higher Sharpe ratio. So the labeling of those columns should be the other way around. So two benefits so far of our low volatility strategy. First of all, reducing exposure to other well-rewarded factors. And secondly, using a more diversified weighting scheme leads to better long-term risk-adjusted return. So this is the underlying strategy that we use to apply our maximum volatility protection. So as we showed earlier, we apply a maximum volatility protection to avoid volatility peaks. And we apply this volatility protection to our version of the defensive strategy, which is a factor harvesting approach, selecting low volatility companies and then diversifying. So the question that remains is, how do we control for the volatility, particularly during times of stress? So what we do is we apply a maximum volatility protection. It's a risk control where the main objective of this risk control is to try to target the historical long-term volatility of our low volatility index. So the idea is we want to try to avoid the spikes. So what we're going to do is we're going to try to target the volatility, the historical long-term volatility, and avoid some of these volatility spikes. So in periods where we expect the volatility to increase, what we're going to do is we're going to make an allocation to a cap-weighted overlay. So what we're going to do is short the cap-weighted portfolio, which can be done simply using futures, to prevent to lower the volatility in periods of time when the forecast volatility is expected to rise. So we use a very robust forecasting volatility model. We look to see how much we expect the volatility of our low volatility strategy to increase over the next week. And if we see that the volatility is expected to increase, and to increase by more than 20%, what we'll do is we will introduce an overlay that reduces our exposure to the market, and the quantity that you need to use as part of the overlay will obviously depend on how much you're trying to reduce the volatility by. In other words, how much you expect the volatility to go up compared to the long-term historical volatility. And also because we're using a cap-weighted index to reduce our exposure to the market, you also need to control for the market beta, because the market beta of our low volatility strategy is lower than the market beta as well. So the overlay position is reviewed on a weekly basis, but is not changed unless it requires an allocation of more than 20%. So we have a buffer in place not to change the allocation to the cap-weighted overlay unless it exceeds an allocation of 20%. And in order to prevent us getting stuck in a certain band, in a certain buffer, we reset the allocation on the third Friday of each month. So why a 20% buffer? Obviously, what we want to do is we want to avoid being whipsawed, going in and out of the cap-weighted overlay frequently. And a 20% buffer means that on average, you're changing the allocation to the cap-weighted overlay roughly once a month, to give you an indication of how often you need to change. Obviously, during times of market stress, you're going to be much more active in terms of the overlay, but at times when market volatility is stable, then you make very, very little. In fact, you make no changes whatsoever. So this is our maximum volatility protection that we apply to our low volatility index, which has better risk-adjusted returns as well. The underlying low volatility strategy has better risk-adjusted return than the min-vol index. So there is one more benefit of our dynamic defensive strategy. So in a multi-asset context, it's very important to also think about the exposure to fixed income risk, because the other asset class that is held, in addition to equities, tends to be fixed income as a safety net, if you like. So in terms of exposure to fixed income, you want a lower exposure to fixed income, because a lower exposure to fixed income means that you have a better diversification property in your equity strategy. So we can see here the exposure that the MSCI min-vol strategy has in the far right-hand column to both short-term interest rates, T-bills, and term spread. So you can see it has a negative exposure. So it is sensitive to interest rates, negatively sensitive to interest rates. But our dynamic defensive strategy clearly has a much lower sensitivity to interest rate risk. So clearly this is important as well, because in addition to having lower average volatility, it also has a lower correlation to fixed income, which also helps us in terms of lowering the overall volatility of our multi-asset portfolio. So our dynamic defensive strategy also has lower exposure to fixed income, and clearly this is beneficial in a multi-asset framework. Okay, so that's a little bit of an explanation of how we design our dynamic defensive strategy. So now, in the next couple of slides, I'd like to look at some of the performances of our dynamic defensive strategy, particularly compared to more traditional defensive strategies. So the interesting thing about the dynamic defensive solution is that you end up with a reduction in market beta during times of stress. So if we look at the far right-hand column, you can see that the MSCI min-vol strategy has, during periods of low volatility, it has a beta of about 0.74. So it has a lower beta to the equity market during periods of low volatility. But during times of stress, when volatility rises, during periods of high volatility, the market beta actually increases compared to periods of low volatility. You can see it increases from 0.74 to 0.82. So this is what we mean, that the traditional defensive strategy is not low volatility at all time, because the actual exposure to the equity market actually increases in times of stress. Now, our maximum volatility protection, our risk control, you can see that we have a similar market beta in times when the low volatility, during periods of low market volatility. But during periods of stress, during periods of high market volatility, our market beta is actually lower than during periods of low market volatility. So we have this dissymmetry in terms of market beta. We actually lower the market beta of our strategy, which ensures that we have very good protection during times of stress. So finally, turning to some performances. So here we show the performance of a cap-weighted strategy that's used in traditional multi-asset portfolios. We also show the MSCI Min-Vol and the dynamic defensive. So you can see that the MSCI Min-Vol does indeed have a lower volatility, annualized volatility, the second row, compared to the cap-weighted portfolio. But our defensive solution has significantly lower volatility, average volatility. So the MSCI Min-Vol reduces the average volatility by about 16%. Our strategy doubles that reduction. We have a reduction of about 40% in average levels of volatility. Now, in terms of return, they actually, our dynamic defensive solution has slightly lower returns, but similar levels of return. And that, of course, means that we have a much higher Sharpe ratio than more traditional more traditional strategies, such as the MSCI minimum volatility strategy. So the Sharpe ratio improvement is 52% compared to the cap-weighted portfolio, whereas typical minimum volatility strategies have an improvement of around about 20% over the long term. So we have a lower average volatility, we have a volatility reduction, but also remember that by eliminating our negative exposure to well-rewarded factors, we have a stronger factor intensity, we have a stronger exposure to other factors, and what we've seen that means is it actually gives us a pickup in terms of return as well. So that's basically covering the main elements of our dynamic defensive solution. So what I'd like to do now, before I hand back to Simon, is just to conclude. So we observed today that many private clients wish to have low-risk funds. They use multi-asset funds, low-risk funds, which involves making an allocation, a large allocation to fixed income. But as Simon has pointed out in his introduction, is that the non-risky component of this multi-asset portfolio from the fixed income side, the returns from fixed income are very low. So it would be more attractive if we could make a greater allocation to the equity component, provided that equity allocation is well protected. So putting a greater allocation to equities using a well-controlled volatility risk is an alternative to making a very, very high allocation to fixed income with a low expected return, particularly in the kind of environment, a high interest environment a high inflation environment, which has a negative impact on fixed income. If instead we can make a greater allocation to the equity portion of the portfolio, but nevertheless still control both the extreme and average volatility of the portfolio, that should lead to better long-term risk-adjusted return. So with that, I'd like to conclude. Simon, are there particular points of the presentation that you wanted to pick up on before we turn to the Q&A?
Yeah, sure. I think we could touch on some of the Q&A. There's a few questions from the audience who are interested to learn more, which is great. First and foremost, one of the questions is, how does our low vol index actually achieve the desired objective of limiting or avoiding negative exposure to the other factors?
How does our low volatility strategy avoid the negative exposure? Okay. So what we do, the way we design our low volatility strategy is we want to collect the low volatility premium. So we make a positive selection in terms of low volatility stocks. So if we take a US universe, what we actually do is we select 50% of the companies with the lowest volatility from three main industry groupings, from financials, from technology, and also from the rest of the market. So the idea is that we get a diversity in terms of stocks that have low volatility. So the second stage of the process is then we eliminate the companies that have the most negative exposure to the other well-rewarded factors. So the way the filter works is we calculate a composite score based on the other factors. So we calculate a composite score for each company, each low volatility company. We calculate a composite score. We then rank all the companies, and we simply eliminate the companies that have the lowest or the most negative exposure to these other well-rewarded factors. And in practice, the way it works is we positively select 30% of the stocks with the lowest volatility, and then we deselect or we filter out 10%. So we end up with 20% from the underlying universe. We deselect 10% of the stocks that have this most negative exposure. So the way to avoid the negative exposure is simply to eliminate the companies that are giving us this negative exposure in the first place.
Okay, that's great. Thanks, Eric. There's a couple of questions in regards to our volatility forecasting model. Actually, I'll start with the first question is what type of volatility forecasting model do you use?
Okay, so the volatility model we use, the forecasting volatility model we use, is a Garch model. So it's a special type of Garch model, a GJR Garch model. And essentially, in order to ensure that we have a robust estimate of the forward volatility, we take into account some stylized facts as far as volatility is concerned. So we take into account the fact that volatility tends to be persistent. So we take into account volatility clustering, which is typically what Garch models tend to do. So periods of high volatility are followed by periods of high volatility and vice versa. So that's the first thing a Garch model takes into consideration. The second thing is we take leverage effects into account as well. So the idea is that when you get a shock in terms of volatility, the leverage effect is basically saying that stocks with a high degree of leverage are more exposed to volatility shocks, so we take that into account as well. And also, typical Garch models tend to use a normal distribution. We also take into account that returns are not non-normally distributed, so we also take into account the fat tails of the distribution using a student T distribution instead of a normal distribution. And finally, the fourth element of our volatility forecasting model is we also want to ensure that we also take into account jumps in terms of volatility, structural breaks. So we in fact actually estimate two kinds of GJR Garch models, one that uses a very long window and one that uses a short window, and then we use an average process. So we actually have some, if people are interested in this model, we do actually have a white paper about this, but to just summarize, it's a Garch model that takes into account four main elements. It takes into account volatility clustering, it takes into account the leverage effect, it also takes into account the fact that returns have got fat tails, are not normally distributed, and it also takes into account structural breaks when we forecast volatility.
Yeah, thanks, Eric. Just want to remind the audience that you can actually send us an email to webinars@scientificbeta.com should you request any further information that is of a more specific nature. Some of the models can get a little bit complex and perhaps go beyond the scope of the discussion that we're having today. Okay, next question, Eric, again on the volatility forecasting. What would the results have looked like if you did not use your volatility forecasting model? So there are a lot of providers in the market that have a traditional look-back methodology of standard deviation of returns. and simply reallocate between the equity component and cash component. So, how would this have looked if we used an alternative method compared to our volatility forecasting model in MVP?
Yeah, okay. So in fact, in our white paper, we also look at a more traditional approach to try to forecast volatility based on exponential smoothing of volatility over time. And what we find is that using our volatility forecasting model, it is far more accurate than simply using a smoothed version of the historical volatility. So we actually measure how accurately we're able to forecast the volatility compared to using a smoothed version of volatility. So we find that we have a much more accurate estimate of the realized volatility using our model than compared to using a more smoothed version. So therefore, it helps us to make this allocation more precisely.
Okay, there's quite a few more questions on the volatility forecasting model, which I think we'll pass on for now. Like I said, for our audience, please reach out to us at webinar@scientificbeta.com, and we'll be sure to follow up on your inquiry. There's a couple of other questions in regards to in regards to the coverage that we have on dynamic defensive. So we see that the presentation is focused on the US market. Do you also offer dynamic defensive on other regions?
Yes, absolutely. Yes, we've used the US example here, but we also offer this strategy based on developed markets and also on global markets, which includes emerging markets. So yes, this strategy is also available. Now, in terms of designing the strategy for developed markets, the reason I used one particular market, it's very easy to explain. But when you create a low volatility strategy across multiple regions, you need to also think carefully about the regional aspects, because you can actually introduce more macro sensitivity depending on how you allocate to the region. So what we actually do is we calculate or we create, if you like, our low volatility strategy on a regional basis. So we create the strategy in the US, and we create it separately in the Eurozone, and so on. We create it across multiple regions. And then in terms of allocating to the regions, we actually allocate to those regions based on the same weight as those regions have in a cap-weighted portfolio, because the idea is we don't want to take on additional macro risk. That's one thing we want to avoid. So our developed world strategy and our global strategy, which includes emerging markets, actually has the same regional allocation as a cap-weighted portfolio, and it avoids this additional macro exposure that you get if you don't control for regions.
Right. Okay. Thanks for that, Eric. Do you have any kind of sense of how the dynamic defensive solution has performed in global developed, for example, or in emerging markets?
Off the top of my head, no, not for emerging markets, but I did have a look at the more global portfolio, particularly over the first quarter. It has done particularly well during the first quarter. But I guess what's probably even more important is what happened last year, particularly during the COVID crisis. And again, the idea is we're not really focusing on performance. So if we look at what happened during the COVID crisis, the volatility control kicked in very, very quickly after the first week. So we had a lot of volatility protection as the COVID crisis unfolded, and it actually meant that the strategy outperformed because we had less exposure. But the objective was not to try to outperform. The idea was to try to protect ourselves during a time of crisis. So yes, it outperformed during the COVID crisis, but then it obviously underperformed a bit as markets recovered and have bounced back. Now, more recently, over the first quarter, compared to more traditional strategies like the min-vol strategy, this strategy, which doesn't actually have the risk control in place at the moment, so it's a pure low volatility strategy, has performed extremely well compared to more traditional defensive strategies.
So I guess, Eric, you could say that the dynamic defensive is perhaps more of a long-term tool as part of a strategic asset allocation. Would that be right?
Yes, indeed. I mean, that's exactly how we think of it. The idea is we think of it very much in terms of risk, because I think when you design and create multi-asset portfolios, asset managers who create multi-asset portfolios think in terms of targeting a certain level of average risk over the long term, or targeting a certain level of drawdown. That tends to be the focus of multi-asset portfolios, is to think of it in risk terms. Now, if you have a strategy that is able to allocate more to an equity strategy which has better long-term risk-adjusted returns than fixed income, then clearly you're heading in the right direction. But the objective here is really to focus on the risk side, targeting either targeting a certain level of volatility or ensuring that you're not exposed to extreme levels of risk. And if that means you can then allocate more to the equity portion of the portfolio, clearly that means that it'll lead to better risk-adjusted returns over the long term.
Okay, thanks very much, Eric. I think we'll start to wrap up now. There are obviously three key takeaways from this webinar. So first and foremost, our dynamic defensive equity solution is very effective in smoothing the effects of volatility when compared to other traditional defensive solutions. Second of all, with our dynamic defensive equity index, you can actually increase your exposure to equity for a given level of risk. And thirdly, it should be seriously considered as a substitute, at least in part, for the fixed income component of a multi-asset portfolio, especially as we are now being confronted with the very real risk of inflation and a rising rate environment. I'd like to thank you all in our audience today for your time and your participation. Please do reach out to us at webinar@scientificbeta.com should you require any more information. Thank you very much.